Portions of the following program may be pre-recorded.
The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity. Prepare for your retirement. Safeguard your savings. And nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Good morning. Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings, investments, and your retirement. This is the last show of the new year of 2024, and we have a lot to talk about. Our show is all about saving money, building up wealth, and understanding the world today. We've been on since 2007 we started, 2006 in there. So it's one of Houston's more popular radio shows and on financial radios. And we're talking savings, investments, and retirement. Our motto and our philosophy is to save aggressively and invest conservatively. That's the key to building up wealth over the long term. To save aggressively and then invest it conservatively. And you start out, it's a year end, and we really need to talk about this right away, is the importance of saving money in your qualified 401k plans, your different savings plans. And what those are different types of programs that will get you where you need to be for retirement. And the key to these things is you get a tax deduction, as well as you get tax-free growth. And what that does is that puts you where you need to be for retirement over the long term. And hence the name. What you're looking at is, hold on just a second, let me move. We seem to be having an issue with one of our things here at the show. This is a little better right here. So what we're looking at is how do we sit there and save money? What you want to do with these qualified savings programs and put the money away for retirement. You're going to get the tax deduction and you're going to get the tax-free growth. This is the key. Is these are income-based savings programs. They're going to get you where you need to be for retirement based on what your income is. If you're making $30,000 or $300,000, it doesn't make any difference. These plans will get you to the amount that you're saying. Because if you're living off of $30,000, or if you're living off of $350,000, and we've had clients on both sides of the equation, you can build up enough for your standard of living. And what does that take? It takes 10% plus the company match, gets you up to about 13%. I was talking to someone yesterday, they're getting 6% in their match in their savings program. This will get you there that much quicker, but you have to put that money away. You have to take charge of your retirement, and first you've got to do that in order to sit there and get where you are for retirement. If you're not there, now's the time to get there. This is why we're talking about the year-end show. Make a resolution, a New Year's resolution, to put away more money, to build up wealth, and to understand the world today. That's going to be the key to the entire thing, is save aggressively, invest conservatively. Then, once you save up enough money, you come to retirement, you can talk to us at Max Out Savings Advisors. Now, a couple things here. We got quite a bit to talk about this show. We're going to kind of do sort of where do we go for the new year? We had a good year for the S&P 500 in the tech sector. Other sectors really didn't have that good of a year. If you sit and take a look at the bond sector, it was not good. If you look at if you look at the 10-year bond, the 10-year bond started out the year right about. It's interesting. If you look at this market, start of the new year for 2024, everyone said that, hey, interest rates are going down. The Fed is going to be cutting rates. Rates are going down. This is good. The stock market's going to go up. It's all going to be fantastic. The new year started out, the 10-year bond was about 4%. And it ends right now at 4.6%. Fed cut rates 75 basis points. So what happened? Why are rates going up? Since the Federal Reserve has started cutting interest rates, the longer end of the curve, which is like a 10-year, is up 100 basis points. 100 basis points. And that's never happened before. And what is this saying? Typically, when that happens, the Fed starts cutting rates, the economy is slowing down, people go, oh my gosh, rates are going lower, inflation's coming down, and longer bonds go down. It didn't happen this time. The Fed has been too aggressive in cutting rates as usual. Always, they had the election coming up. They were trying to get Joe Biden reelected. They failed. And they cut rates into the election 50 basis points. And as soon as they started cutting rates in September, long-term rates went up. And it looks like the same. So why are rates going up? This is something we have to look at. Well, there's a number of statistics on that, or not. There's some numbers that we need to take a hard look at to kind of understand, what's going on. Why are rates going up? A couple things. People think inflation is going to come back up. They're concerned about it. They don't trust the out of control government spending. But what we're dealing with is a situation where let me run some numbers. Look, as we've talked about on this show for a while, what we've been saying is going into the election, we said, look, the Biden administration is going to do everything humanly possible to ensure that they get reelected. They're going to spend as much money. They're going to shove huge amounts of spending into fiscal 2024, which ended September 30th. They're going to cut rates. They're going to give out free money to everybody. Just to be reelected. And they pressured the Federal Reserve, and of course the Fed fell right into their trap and cut rates. Well, how did they keep rates down? So rates went up anyway. So what's going on? Well, here's some numbers you need to understand. This is important. We've been saying it. Donald Trump is going to we're huge President Trump supporters, long-time listeners of the show. They don't remember back in 2016? God, it's a long time ago, when we said that we thought Donald Trump was going to win after the Republican convention. We made the statement that Hillary was ahead. Hillary was winning in that election. We sat and said, look, Donald Trump is going to win. We think if they have 2 weeks to take out Donald Trump. If they cannot do it, Donald Trump is going to be the next president of the United States. We were the first people in Houston that said it on the radio. At the time, we understood what was happening, and there was a movement going on with Donald Trump, and we felt the polling numbers were wrong, and we were correct on that in what happened. And so this time, the Biden administration, they're playing a rigged game. They've got the establishment, everyone's against Trump. So what did they do? They go, oh my gosh, rates are going up, inflation's going up. We need to hide this from the people so we can tell there's no inflation. And this is important. So what Janet Yellen, the Treasury Secretary, did is she shoved all the borrowing, the typical borrowing from, it's about 1 year to 18 months is about, in 2023, was about 15%. In 2024, that borrowing level of the total Treasury borrowing went up to 30%. This was keep in mind, short-term rates is where the Federal Reserve can control interest rates. They can't, years ago on one of my shows, I had Treasury Secretary Bob Rubin on, and he's like, look, the Federal Reserve can't control interest rates, long-term rates. They can't do it. They can only control short-term rates. This was Treasury Secretary Bob Rubin said this. And so she knew that by pushing all the borrowing short-term, she was going to force the Fed to cover the borrowing and keep interest rates down and hide the fact of inflation coming in. So what happened is that the They increased the short-term borrowing from 15% to 30%. That kept rates low. Well, now, rates went down into October, September, into January, July, August, bottomed in September. Remember, what did we say 3 or 4 months ago, before this, probably 5-6 months ago? We said, look, the thing that's the most important is it's not how the economy is November 1st when the election. It's how the economy is September, early October. That's when everybody makes their decision on the presidency. Typically, the research says it's September. That's when the rates hit at 3.6% on the 10-year bond, because they wanted to shove the rates down. Inflation's going down. Interest rates are going down. The economy's booming. You need to reelect Joe Biden. Now, it's like, Ted, why are you talking about the election? It's over. No, it's not. The election's over, but the consequences of the elections are only beginning, and this is what you have to understand. So what we're looking at here is they shoved interest rates way down. The Fed made a big cut in interest rates in September, right when that decision-making process was happening to try to help out Joe Biden. Janet Yellen borrowed all the money. She had to borrow trillions of dollars, and so what she did is she put 30% of it short-term to keep the long-term rates down. Well, let me give you some numbers here. In 2025, the Trump administration, now because of this, they're going to have to refinance because there's so much was borrowed short term. Remember that 30% of it was very short term, so it has to be refinanced every year. So for 2025, it's $7 trillion that the new Treasury Secretary has got to sit there and borrow in the market. $7 trillion of new money. Now, some of it's bonds coming in, some of it's deficit spending. Now, that is twice what it is for 2024. So they're going to have to find borrowers for twice as much bonds as they did in 24. This is 3 times the amount of bonds as 2024. So big investors around the world are looking at this and they're going, oh my God, the United States government is borrowing $1 trillion additional borrowing every 100 days. Spending is out of control. For the last 3 years, the deficit has been 6.5% of GDP. Deficit spending every year. Spending is out of control in the United States. I'm backing away from the Treasury market, and so Donald Trump is coming on to a disaster in the borrowing because he has to somehow refinance all these bonds twice as much as 2024. Because again, what they did is Joe Biden tried to give people a false impression of the economy and the borrowing situation, and now Trump, we're going to have twice as much borrowing. So what's happened? Well, since the Fed cut rates, September 19th, 18th, somewhere in there, rates were at 3.6%. They're at 4.6% on the 10-year. They're up 100 basis points. They're going up. The last 3 weeks in a row, interest rates have been climbing. They're at 4.6%. And they're headed higher because people are like, where are you going to get the money for this? You're going to borrow from the Chinese? You're going to buy it from the Arabs? You're going to borrow from the Europeans? They're like, hey, we're not. So the only thing that Trump can do, and this is important, is they've got to come out with that Doge Commission, and they've got to come out with a reasonable budget that people they can't go cut everybody's taxes and start spending money on defense and everything else. They do that, the interest rates will climb above 5.5% in the 10-year. The stock market will collapse, and the bond prices will collapse, and the dollar will collapse. And so they've got to sit there and do something. So what I'm trying to let people know today is, look, you guys have been we've been set up by the Biden administration, and they basically have looted the country, and they're coming in and they're throwing just a pile of garbage on Donald Trump. And so the idea that the stock market is going to be booming next year is a fallacy. Now, look, I can make a case it could be $10,000, $20,000 next year if we go into a hyperinflation. But so what we're going to have to see is Donald Trump and his team and Treasury and the rest of the government is going to have to move very quickly. Go, guys, we're serious. We're cutting spending. We're not messing around. We're going to make government more efficient. We might do some tax cuts. Most likely, there's going to be some type of tax credits for spending for new factories and things, and to try to get the economy going and to create confidence that, look, hey, to use a term that Speaker, the Senate Leader McConnell and that jackass who I forget his name, who was head of the House at the time when Trump came in, they were going to be the adults in the room, and Speaker Paul Ryan, and this time the adults are coming in the room, and we're going to try to reform the government. We're going to try to get it on a clear fiscal path to solvency going forward, and we're going to prudently spend money. If they do that, then we have a way to get through this. If they don't, so the point is, trouble is coming, and this is what the market is signaling, and this is why you've got to sit there and be cautious in here and understand the world today. We'll be right back to discuss some more of this right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
Hey everybody, Charlie Kirk here. Ted Gioka, the founder of Max Out Savings Advisors, always says, save aggressively and invest conservatively. He specializes in helping people grow their retirement account with as little risks as possible. Ted combines working knowledge with the intuition gained from over 25 years of experience of value investing in the stock and bond markets for retirement accounts. Like you, Ted is deeply conservative in life and in his investment approach. His risk strategy allows him to anticipate market downswings to protect your money. Ted is also the conservative host of the Max Out Savings Show. You can listen to him every Saturday morning at 10 a.m. right here on The Answer. If the idea of saving aggressively and investing conservatively appeals to you, the best way to get to know Ted is to call him. The number is 713-627-0400 or visit maxoutsavings.com. That is maxoutsavings.com. Call Ted right now, 713-627-0400 or visit maxoutsavings.com.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday at 7 a.m. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com.
Once again, here's your host for the Max Out Savings Show, Ted Gioka.
Welcome to the Max Out Savings Show. We're talking savings, investment, and your retirement. Year-end, looking out to 2025, we've got a new year coming up. So what's going to happen? One of the things is there's going to be huge pressure on interest rates as borrowing costs increase. Understand that we're going to borrow twice as much money as in 25 as we did in 24. And by the way, this isn't calculating that Donald Trump's going to spend a bunch of money. This is just because of the setup that Treasury Secretary Janet Yellen left the Trump administration. And so we'll be dealing with that. We're also dealing with an economy where inflation is continue up. The question is, are we going to have another leg up in inflation? And a couple things to look at. If you look at the wages are continuing to go up. A lot of these union contracts are coming in, and when there's a union contract, a lot of people around them also get wages, and we're kind of seeing some of these union contracts come in because they didn't get raises a couple years before this because they were under contract. So we think the inflation is still there. And if you look at oil prices, oil really hasn't done anything this year. It's trading right now at about It's actually down in the year. It's about $1 or so lower. And the question is with the drill baby drill, are we going to see a big drop in oil prices? Look, we don't think so. Look, a lot of the oil companies, they've learned their lesson. It doesn't do any good for everyone to grow their production 10%, and they're all patting themselves on the back and announcing to Wall Street that their production growth is 10%, and then the price of oil drops 15 or 20%, and nobody makes any money. And so if you look at the price of gasoline, you get it for $2.50 a gallon. That's pretty darn cheap in any way you look at it. So again, we think oil prices are likely to go up. For 2025, look, we like energy stocks. A couple things. Look, I think what we saw was it yesterday or the day before when the stock market fell 500, almost 600 points intraday, and the tech stocks started collapsing. When that happened, one of the few sectors was up was really energy, because energy is cheap. The energy stocks are cheap in here. Oil and gas hasn't really gone anywhere this year, and a lot of the portfolio managers were dumping the stocks because they want everyone to just see they have nothing but hype, but big mega cap tech stocks in their portfolio. So we think energy is going to be one of the places for 2024. If you look at it, the European economy has been slowly collapsing as Germany, moves, with slow and steady pace to destroy their economy as they've cut themselves off from cheap energy from Russia. They're engaged in all this green energy, which is very expensive in rules and regulations. China is in the worst slowdown in decades. They're in trouble over there. If you look at other parts of the world, the global economy is slowing. The U.S. is doing well just because we've spent so much money. I mean, President Biden spent like a drunken sailor, and that's coming to an end. I think oil prices are already factoring that in. I think you're going to see oil hold in here and do reasonably well. Same with natural gas, which is near multi-decade lows on gas. I remember in the 1990s when if we got $5 gas, it was good. And $4 gas was okay, and you're drilling oil wells and making money. Now gas is $2 to $3 an MCF, and you put some inflation numbers on it. We're probably at the level that was in the 1950s for natural gas. So we like energy. I think energy is going to do well. The economy here looks to do well because there's a lot of industrial spending, infrastructure spending. We got defense spending. We're going to have to increase that and moving factories back to the U.S. The problem is inflation. Inflation is badly hurting lower middle class people. If you look at the spending, there's been a huge bifurcation for Christmas. Newell, they were talking to the president of Newell, which makes all types of different products, and they're talking about blenders. The blenders they have that are under $20, they're not selling at all. The high-end blenders over $100 are selling like crazy, and what they're doing is they're expanding the blenders, making them even better. On the high end, they're just leaving the other blenders where they are. People with money, with two jobs in corporate jobs, are doing well. Other people aren't doing as well, and so inflation is really starting to dig into the middle class, in lower middle class. This is going to force Trump to be more populist than he would be. If you look at his administration, as the election went on, it became more populist. I mean, if you look at Donald Trump's first run for presidency, he's like, hey, I'm sick of these immigrants. We're putting up a wall. We're shutting this down, and we're cutting taxes everywhere. That's not what you heard this time. We're putting up a wall where we're going to deport the immigrants, which needs to be done. But you're also hearing RFK. The most popular guy in the administration after Donald Trump is RFK Jr. He's a Democrat. He wants to sit there. He's got huge support across the entire political spectrum on left and right, massive support, and he wants to sit there and clean up the food, make food great again. One of my sons wants to order a "Make Food Great Again" T-shirt, RFK on it, and it's just because people today, they want good quality food like the Europeans have. Say what you want about the Europeans, they know how to eat. and their food is better quality. And numerous people I know can't touch certain types of food like pastas and different things here in the United States. They go over to Europe and have no problems whatsoever with them. They don't. And clearly, there's issues with all types of things. So that's going to be, if you look at other people, Tulsi Gabbard, she's a former Democrat. These are more populist people. The working people want change. The working people put Donald Trump in there. It wasn't the elite class. It wasn't Wall Street. Wall Street's been beating down the door on Mar-a-Lago trying to go, give money to the inaugural committee and meet Donald Trump, Goldman Sachs, people like that. Well, they didn't do anything to help out. The tech sector didn't do anything to help out Donald Trump. And so he's going to be working for the working people. It's a different president. So look for a lot of things to try to make people's lives simpler, to reduce regulation, make things cheaper. They've got to reduce inflation. And that inflation's tough to do, but one of the things you can do is if you can cut regulations that's making something more expensive and make it cheaper, that's a win. And so I think for 2025, it's going to be about tax cutting. Is going to be targeted for investment. I think regulation is going to be targeted to reduce cost, to reduce government spending and reduce products going to working people in this country. These are some of the things, because they're going to be under the gun. They've got to produce this stuff and get things done. So it's not going to be the same pattern as before. As we said at the beginning of the show, President Trump is coming in. He has to borrow twice. His team at Treasury has to borrow twice as much money as they need to refinance twice as many Treasuries as Biden did last year because of the way that Biden moved all their borrowing short term. And so that's going to put pressure on interest rate. It's going to be a very tough job. So what we had is we have a slowing economy. We have a bifurcated economy, and we're going to have to changes come in, as we just talked about with the spending. So where do we go from here? A couple thoughts. Like I said, I think what was that? I think it was the 2 days ago. The stock after Christmas, the market fell like 500-600 points. Oil and gas went up. Hey, that's a tell. That's what's likely going to do well next year. The tech sector got blasted. If you look at some numbers on the tech sector, the big, I don't know how many different times we've looked at this. Another statistic I saw, in 1999, the mega caps came in, they were 28% of GDP. So if you look at the enterprise value of the big tech, of the top 10 tech companies, it was about 28%. It's now up to 64% of the enterprise value to the economy. It's twice as much, which means these big mega. Look, in 1999, the bubble was in was all types of stocks at 100 times earnings and getting ready for the internet. For 2024, the bubble is the AI stocks. It's the big tech stocks. They've all wrapped themselves in AI, which is requiring additional spending, and it's expensive. And so the market capitalizations of these companies is just gigantic. And so the economy cannot support these companies this much. It's the top 10 mega cap stocks. Are twice as much as they were during the tech bubble. If you look what happened 2 days ago, that's what fell apart in the market was these big mega cap tech stocks. I think it just started. Look, I think you're coming up here and, next week the year ends. Next year, 25 starts. That means next year on January 2nd, you can go sell all your tech stocks. You don't have to pay taxes for next year. If you do it right now, you've got to make a check to the United States government. It's going to be on your taxes for this year. And that's a powerful incentive for a lot of people out there not to sell these tech stocks. That's coming in. A lot of portfolio managers want to leave them all in the portfolio to dress up the portfolio. That ends next week. And that's when I think you're going to see pressure on the tech sector. I think for 2025, big mega tech is going to underperform. That's another thing. Energy is going to outperform. Tech is going to underperform. longer-term interest rates, there's going to be huge pressure on that, and there's going to be huge pressure on the market. Now, if you look at and one thing, I saw some numbers that the 60-40 stock and bonds, the standard portfolio since the end of 2022 is actually, I think it's the end of 2020. They said 2022. I think it's the end of 2022. Or wait, let me see. Let me pull this up. I don't think the statistic was completely accurate because I went and checked it. Since the end of 2021, the 60-40 bond portfolio is about even. During that time, gold has gone up about 40%. Now, I'm going to repeat that because all you hear about is the S&P 500, but most retirement plans, they have to have a balanced portfolio. They're about even. And this is because interest rates have gone up and bond prices have gone down dramatically, and this has hurt portfolios. This is why we've said you want to be short-term on bonds, although I kind of thought we're going to make some adjustments. We have one long-term position in bonds, but that's what's worked. Precious metals. This is another question. What does that do for 2025? Higher inflation coming up, higher interest rates. Typically, higher interest rates aren't good for the bond market. And so what I think you're going to see happen is a couple things. The dollar has started going up again. It's been rallying quite a bit. It's up year to date. And again, it's the same thing. The dollar has been rallying dramatically since the Fed started cutting rates. And what that appears to be is there's a scramble for safety there. I think you're going to see the dollar sell off here later this year in 2025, but it's going to have to be, you're going to have to see the interest rates go up, and then you're going to have to see the market sell off. This is going to trigger a market sell off. If you look at the 10-year bond right now is in the warning zone. If you talk to a lot of these strategists on Wall Street, and the research says, look, market's fine, everything's going up, we got good growth, the S&P 500 is going to go up 10% next year, everything's great, it's probably going to be another 20% up year. Well, they're cutting it back to 10 or 15%. But if you talk to those same people, every one of those people to a person will look, if rates start going above 4.5% to get near 5%, it's going to be real trouble for the stock market. And this is the problem. Right now we're at 4.6% on the 10-year. So we're in the warning zone on the stock market because at 4.65% for 10 years, that's pretty strong competition for stocks at 30-something times earnings. We talked about Walmart at 36 times earnings. What do you do? It started the year. This is when we talked about last week. Walmart at the beginning of the year was at 11 times free cash flow, which wasn't bad. That's a pretty good rate of return. Competes with bonds. Now it's at 19 times free cash flow and 37 times earnings. Well, what's going to do better? 4.6% in treasuries are guaranteed for the next 10 years, or Walmart at 37 times earnings, one of the largest companies in the United States. How much more can they grow in 10 years? Now, the better way you could, like, for instance, you can look at something like an Academy, a local Houston company, probably at 8-9 times earnings. Their earnings are growing. And by the way, Walmart's at about 7-8 times growth rate, 36 times earnings. That's not a great deal. You can get Academy. It's got a reasonably good growth rate. They're buying back stock. They have a dividend. They're expanding, and it's at 9 times earnings. So that's what, in this market, it keeps going back to this froth is in these mega cap, super big stocks that all these institutions are piled into. Well, for 2025, what's going to happen there? We're going to talk about that after this quick break in the Max Out Savings Show. What I want you to understand is the regime is changing. A new presidency is changing. The bond markets are changing. Everything is changing. But one thing we're hearing is the stock market's not going to change, and these big caps are going to keep going up. We'll see what happens and discuss that right after this quick break in the Max Out Savings Show.
If you've got savings and investment questions, Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com. In the 1970s, the big song was the Bee Gees' Stayed Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
We return now to the Max Out Savings Show. Here's Ted Gioka.
Welcome back to the Max Out Savings Show. We're just talking about what is the opportunities going to be for 2025? What are the changes? What's going to happen there? And some of the things we were talking, these big mega caps, I don't think the mega caps are going to outperform. They outperformed this year. I don't think they're going to outperform. The valuations are extreme. The capitalizations are just incredible. And some of them are closing in on $4 trillion market cap. As we said, the top 10 stocks are really at enterprise value of 64% of GDP. At the peak of the bubble in 1999, they were at 28%. They're going to run into growth problems because it's just on size alone. And so we think that, and interest rates are rising. And so we don't think that's going to be the place to be there. The other sector that is going to, I think, is going to look good is going to be more the commodities, the industrial sector, as there's going to have to be a build out of industry in the United States. That's where I think the opportunity. I think they're going to target the equipment tax credits and different things like that to boost the economy. Silver and gold, I think the silver and gold mining stocks are going to do quite well next year. Silver, I think, is going to make a run to $50. It's lagging to some extent. And there's enormous amounts of silver being used for the AI build-out, the solar power build-out, and different things. It's moved about the same price. Gold and silver are up about 24%. Typically, silver moves about 50% more than gold. And it hasn't happened this time. I think you're going to see that move happen next year. So, this is going to be another sector that we think is going to do quite well overall going forward. So, let's see here. So we've got rates rising. What else we want to discuss here? Again, I think you want to continue to be shorter term on the majority of your bonds until we really get an idea. The trigger for the longer bond is really going to have to be for long-term rates to fall. We're going to have a substantial drop in the stock market. It's something that's going to have to push it down. And right now, the real real push appears to be on the longer end of as this massive refi bubble that's coming through. It's almost like a python, coming through with its eating an animal or something, where you get this big lump coming through with the $7 trillion worth of borrowing, which is twice what they had to do last year. So again, we want to be cautious in here overall. We got this bifurcated economy, and we're gonna see that. Looking at the different markets, it's really interesting. If you look at the NASDAQ, it's only started to come down. We think it's going to come down substantially. It hasn't really broken down yet or broken trend. I think right after the first year, that's going to start. If you look at the NYA, which is a broad New York composite, much broader move in the market, that one has dropped substantially in across the board and is really broken down. It's under the 100-day, it's under the 50, under the 100-day. The RSI is negative 37, which is, if it goes under 50, that's usually when it's going to trigger institutional selling. So it's, again, the smaller stocks are already correcting, because remember, the economy in China is bad, the economy in Europe is bad, and there's a lot of uncertainty in the world right now. Right now, there was a song, I forgot the name of the song, but one of the lines in it was, "What if they gave a war and nobody came?" And was it Zoran Zam? I forgot if they gave a war and nobody came. Well, what if we had a war and nobody knew about it? And I think that's what we're in right now. I think we're almost in World War III right now, if you look at it. If you look at it, in the last couple of days, we've had an airliner shot down accidentally by the Russians. We had a Russian ship that they claimed there was an engine room fire, an explosion, and the ship is sinking. You look at the ship, and the bow and the front of the ship is sinking. And you're like, wait a minute, the engine room's not up there. So clearly it was torpedoed or something in the Mediterranean, close to the Straits of Gibraltar. How does that? Then we had a power line, a massive underwater power line in Finland, cut by an anchor. We've had fiber optic lines in the Baltic Sea cut. We've had all types of these strange occurrences happening where no one seems to know anything about it. But obviously, this is a very nasty war. We have the Russians talking about nuclear weapons again. We have the Syria's collapse. And look, I think for 2025, I think there's a very high probability Israel's going after Iran, and that's going to be another issue here. And so, again, we have wars in Russia, Ukraine, Iran is going to happen, Syria, Lebanon, Yemen, all over the world. What's going to happen with China and Taiwan? It's like I said, we have this war that appears to be going on that no one is willing to admit. You almost think if we had fought World War II and instead of sending over American soldiers, they would have gone and recruited people from South America or other places. Would that have actually been a world war? Again, this is a nasty situation. We hope that Donald Trump can get in there and solve it, but we still have Biden in there for another month, and there's no telling what we do. We have a president that's clearly he's bordering on senile right now. In all fairness, any way you look at this, he's close to being senile. Who's in charge of the government up there? Who's in charge of the nuclear weapons? Who's in charge of the military? Who is making the decisions to send long-range missiles over to Ukraine to attack Russia, to try to provoke the Russians to attack, to drag NATO into World War III? I mean, that's a fair assessment. We had that advertisement years ago. I think it was from Hillary Clinton. I forgot. It was one of them going, when that call comes in at 3 a.m., sir, there's been a nuclear incident, who do you want answering the phone? Nobody on planet Earth thinks Biden is remotely capable. So the question is, who is answering that phone, and what are they going to say? Are they going to say what's in the best interest of the people of the United States? Are they going to try to push for a war that they think there's an opportunity to take out Vladimir Putin at the expense of the American people? That's a dangerous place to be. And I think we need to understand that and understand the depth of this thing. I mean, again, we keep hearing about all these issues, these strange things that keep happening around the world, and nobody says anything. But if you look at them, they're pretty bad. And when we've seen experts say that, look, we're closer to a nuclear war than we were during the Cuban Missile Crisis. Well, anyone that was alive at that time, I remember, and I was extraordinarily young. My mother was terrified. My father was called up to duty, and we have clients that was actually sent to their ranch because the parents were so concerned and didn't want them in Houston and during that time. So a dangerous time. Anyway, let's take a quick call. Welcome to the Max Out Savings Show.
Hi, Ted. This is John. I'm wondering, I know the big tech bubble, and you're not really recommending big tech next year, but we keep hearing about the AI build-out, for silver and copper and the mining companies. But I always, in my brain, big tech and AI kind of go together. So we're saying big tech is bad, but AI is good.
That's a good question. Look, if you remember 1999, we had the build-out of the Internet. The stocks blew up, but the build-out continued. It's going to be the same thing. The AI is going to continue. I think the money is going to be made on companies that are going to we have Palantir's one of them. You got ServiceNow. They're going to be using the AI going forward to build out. But there's a lot of these. The question is, how much is Apple, Microsoft, Google, Facebook, how much are these big super mega NVIDIA? There's going to be other competition coming in for the chips. They're not going to be the only makers, and they're going to be the ones that people are looking at. What is this valuation? And the problem with Google, with AI, Google, Apple, Microsoft, those companies in Meta is they're profiting enormously off the privacy of the individuals that use their system and selling them and making money and not paying for it. There's going to be pushback on the tech sector when they start looking at antitrust in that sector. I'll give an example. On my MacBook Air, every time I pull it up, turn it on, Apple News comes on. I'm not interested in listening to a bunch of liberals tell me the news. It's very hard to get it off the system. They're going to have to go after these tech companies. The tech companies have done everything they can to sabotage Donald Trump and the American people, and there's going to be big pressure on that sector. We're using the NASDAQ, kind of a hedge on the NASDAQ to hedge out the portfolios, because I think that's where the most risk is in the markets are right now.
Well, and talking about privacy and that kind of stuff, and I hear you occasionally talk about Elon Musk working on some kind of a new phone that will help with that. When you just said that, it reminded me. Where's Tesla fall into with? I mean, they're not like one of the big seven, I guess, but I know they've been making a big move lately. How do you feel about Tesla?
I love Tesla. The problem with Tesla is it's expensive right now. It's at a huge PE multiple. By the way, that phone is likely going to be with X, not Tesla, because Elon Musk is going to work with the tech companies for the self-driving. So it's likely going to come out of X, would be my guess. Twitter, his Twitter. And keep in mind, all that build-out is going to continue, which is going to help the commodities and everything else, plus the build-out of the industrial sector. But it's the valuations in the tech sector. We've been saying this for months now, longer than that, and they've continued to go up, but in a bubble, that's what happens.
Right. Okay. Well, thank you very much.
That's a good question. It's not that we don't think these things are going to work, but the valuations. That's with the internet, the bubble in 1999, the stocks blew up. They kept developing the technology, and I think that's when AMD. A lot of these companies are all trying to come up with their own AI chips. NVIDIA is going to start facing competition, and so that's going to be kind of the way it is. And so I think that's where the risk is. I think the growth is going to be in other sectors of the market. and that's going to give you your opportunities. And by the way, those sectors, if you look at the oil and gas sector, look at the precious metal sector, look at some of the industrials like a Textron, they had to close their Arctic cat plants because demand dropped off. If you look at lots of companies out there, metals, mining, all types of the sectors, farm, there's been a big sell-off in those stocks. As we said, the NYA is, if you look at a chart of that thing virtually crashed from about 20,000, say 2,300 to 18,000 and some change in December. It's kind of came back some. It's going down again. That's all your different types of stocks. That's not technology. You pull up the NASDAQ composite. That one has stayed up. From December, it's up for the year. So the broad market sold off, but the NASDAQ held because nobody wants to sell those stocks because they look good in the portfolio and they're waiting for tax time next year. That's going to change. Remember, everything changes January 1st. Starting then, Donald Trump's going to be in charge. He's going to have to deal. Well, he's not going to get in until about the 21st, but it's going to happen then. And there's a fundamental regime change happening within 1 week on the markets, on the presidency, on the people who will be in charge. Everything is going to change. And so what's worked in the last 2 years is not going to work. It's going to be a different regime. And I think that's what you want to watch out for. Anyway, we're writing about this. The Max Out Saving Report is going to be out this weekend. We'll be writing about that. We're going to put out another one in January, letting you know all these things. You go to our website, maxoutsavings.com, and you can sign up for the free report. It's Max Out Savings Report. Look, we've written about all types of things over the years. We were ahead of everybody else out there on Wall Street when it came to the great financial crisis, when it came to COVID, when it came to the war. It's all in the Max Out Savings Report. It's all free. We send this to you. Just go to our website, maxoutsavings.com, sign up for the free report. A couple of things. Our show on Sunday is going to be at 4 p.m. on Sunday. And if you need some help with your retirement portfolio, you can request an appointment with me here in Houston, Texas at maxoutsavings.com and request an appointment. It's maxoutsavings.com. Until then, remember our motto and philosophy, which is to save aggressively and invest conservatively. That's the key. It's the start of the new year coming up. If you're not saving enough for your retirement, now's the time to make the plan. Call your HR department, increase your savings, build your wealth up, and protect yourself in this very, very volatile world. We'll see you next week right here on the Max Out Savings Show.
This has been the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioka on AM 1070. The Answer.